Fabulous temporary trade agreement in which China says they will buy more U.S. agriculture and agriculture-related goods. What are average investors to do? Joining us to discuss are Peter Schiff, the CEO and Chief Global Strategist of Euro-Pacific Capital, and Danielle Shay, the Director of Options at Simpler Trading. Welcome to you both. Guys, we know some U.S. commodities, notably beans, have lost major market share to China and have bean prices have suffered seriously. But what about companies, which could see some benefits as a result of what's going on? And are there some that could make some major moves? Peter, you first.
Well, first of all, the only benefit that we're going to have is to the extent that Trump completely backs down and walks away from the trade war, because all he's done right now is delay the day of reckoning. He was threatening to punch everybody in the face on January 1st, and now he's saying, well, I may hold off on punching you for another 90 days. So, the only benefit that people derive is the fact that Trump backs down. But, ultimately, I think that he doesn't really understand the dynamics here. It's America who has benefited at the expense of China because we've been getting these huge trade deficits. We get to consume all these things that we don't have to pay for. But there are certain American exporters, like the farmers, who have been doing a lot of business with China. And, they could get caught in the crossfire here. But what we need is more exports to China. But the Chinese government can't force Chinese consumers and Chinese companies to buy American products. What Americans have to do is make the products that the Chinese want to buy. That's the only way that we're going to export.
Well, they may be able to force them to buy beans and stuff, Peter, but you're right about the other products. And I hope you're wrong about the verdict, about the punching in the face after another 90 days. I fear you might be right, but I hope you're wrong. Danielle, what do you think? I mean, is there something really practical, Danielle, that investors could do now, given the current state of circumstances?
Yes. Well, first of all, looking at the beans, I'm looking at soybean futures, and I am seeing a lot of consolidation on the weekly and daily charts, leading me to believe that, number one, from a technical perspective, that could send us higher. Now, keep in mind, we are in a downtrend, of course, so that is a counter-trend bounce. But when you combine that with the overall perspective and everything that's going on in the news, I do see a potential short-term rally, at least into the end of the year, in soybeans. And I think, unless you trade soybean futures, I think the best way to trade that is going to be through soybean ETFs, wheat, corn, something like that.
And are there general, like overall ag commodities? Like, can you buy, is there an ETF for like all grains, or are they specific by the commodity, Danielle?
You can just do it specific by the commodity, especially if you're not too into it. SOYB is a good one. But honestly, this is really a seasonal trade that's kind of overlapping with the overall political landscape. So typically October through December, maybe January is generally a good time to do this. So the best time to get on it was honestly a couple weeks ago. But if you want to look for that next year, it'll be a good shot. And also just keeping in mind the fact that we don't know that Trump is actually that they're actually going to remove these tariffs off the agricultural products. So right now, we're still in kind of a waiting game period.
Right. And Peter, well, I want to ask you both, but I'm looking today at a few of the stocks like John Deere and International Harvester and Caterpillar, and they had not been doing well at all. I mean, even for the last year and year to date, I think maybe in the last year, Deere is the only one that's up at all. But year to date, not up. I mean, you think there'll be some reprieve, even though you think, Peter, the day of reckoning is ultimately coming? Do you think there might be some reprieve for those stocks in the next couple of weeks, or maybe even couple of months?
Well, they've probably already had a bounce, so I don't know about the next couple of months.
They did for like the last couple of days. Lower. You're right, yeah.
Yeah, I think the market is still headed lower. I think what is ultimately going to happen, I think, to blow some more air back into this bubble, it's not just about the Fed kind of, pulling back on some of the future rate hikes. I think it's going to take an actual cut. I think the Fed's going to have to go back to zero if they want to try to blow more air into the stock market bubble. And, you know, I don't think Trump is going to ever follow through with the 25% across-the-board tariffs. I think that's all a bluff. Eventually, he'll probably take that off the table. But I think what's going to ultimately help commodity prices and some of those stocks is going to be a drop in the dollar. And, in fact, I think a precipitous decline in the dollar is coming when traders really understand where the economy is headed, which is into a worse recession than the one we had in 08 and 09, that the Fed is not going to keep raising rates, that they're going back to zero, that they're going to do another round of quantitative easing that's going to be larger than the first three combined. And when the dollar really starts to fall, that's what's going to stoke global demand for all these commodities, and then the prices are going to go way up.
Right. Hey, Danielle, let me ask you overall about markets. I mean, we saw markets get a little bit of a bump last week on Jay Powell's sort of more dovish stance, not cutting rates like Peter's saying, but maybe not as many increases next year. And then we had this trade news, so markets were up a little bit today, several hundred points. But do you think this continue sort of a Santa Claus rally? We've got the jobs reports coming up. We've got the rate increase coming up. Do you think it continue through the rest of the year, or are you skeptical like Peter?
So honestly, I have been pretty bearish this market, especially with FANG dragging it down. But the two caveats that I put to that were if there was, number one, some positive news from Powell, which, you know, sort of what we got. And then number two, the second thing that I was looking for was positive news on the trade war. Now, with the truce in play, we have been able to break through a lot of that overhead resistance in the S&Ps. We did stall today at 28.15, which was really the last key area that I was looking to get through. But honestly, I'm a little bit more hopeful now, at least into the end of the year. Like Peter, I do agree that next year I'm looking for more of a recession to come. But at this point, right now, I'm looking for a run up into the end of the week based on payroll numbers. Historically, you do trade higher into those numbers. And potentially, if we can break through 28.20 in the S&Ps, then I believe that we can see higher prices. But to me, that is the line in the sand. And if we can't do that, then I'm going to look for more downside.
Danielle Shay and Peter Schiff, thank you both so much. Really interesting conversation. Appreciate it, guys.